So as we start the presentation here, just a little bit about our speakers. We have Bob Carbonell, who will be covering Sears and Radio Shack today. He's the Chief Credit Officer for Credit to Be. And we also have Jamie Polanca, who is a Senior Industry Analyst here at Credit to Be, and he will be presenting on Best Buy. So with that, I'm going to pass it over to Bob and let him begin the presentation.
Thanks, Justin. Good afternoon, everyone. Thanks for attending today. Hopefully the snow hasn't kept anyone away, although I've heard some companies have closed early. But we're here for you. In view of recent events, we felt that we should update you on Sears, Radio Shack, and Best Buy, three companies that find themselves in widely different circumstances. One continues to slowly die. One is among the walking dead being saved by a white knight, perhaps, and the other turned in a really strong year as the Best Buy transformation continues. Now, starting with Sears, I won't bore you with all of the history, but since Ed Lampert took over, the company became a real estate holding company that fueled its cash needs by selling off assets. We've seen the sale or spin-off of Orchard Supply, Sears Hometown and Outlet Stores, Land's End, and last November, Sears Canada. Last year, they closed 234 underperforming Sears and Kmart stores, leaving them with a bit more than 1,700 stores overall. Some of the most valuable real estate has been pledged to secure a short-term loan from Lampert and his ESL investments, and the latest wrinkle is the possible formation of a real estate investment trust that they say can raise up to $2 billion this June if it happens. I'll get back to the idea of a REIT a little bit later. By now, you've all had a chance to digest the Sears results for 2014. 11 consecutive quarters of losses and a total loss of about $1.7 billion for the year. 2014 sales declined to $31.2 billion. In the prior year, the net loss was $1.36 billion on sales of $36.2 billion. Now, the sales decline is due to a combination of a lot less stores due to the spin-off of Sears Canada, Land's End, closing of stores, and the decline in comp store sales. Fourth quarter comps at Sears declined 7%, while Kmart comps declined 2%. Those numbers were up against negative comps in 2013, and full-year comp store sales also stayed in negative territory. Sales have steadily declined in recent years as Ed Lampert both continues to shrink the business and is losing customers to stores like Macy's, Walmart, Target, Best Buy, and the all-consuming Amazon.com. The competition continues to innovate and reinvent themselves as times change, something that Sears seems incapable of. Lampert continues to talk about the multi-year transformation of Sears from a major brick-and-mortar retailer into what he calls an asset-light, member-centric, integrated retailer focused on becoming more of an e-tailer. Lampert has committed the business to its Shop Your Way loyalty program, which did bring people into the stores, but at a cost to margins and expenses. In 2014, 74% of sales were to Shop Your Way members. If you have to reward people to get them into your store, you're not doing something correctly. The idea of subletting space in their stores to other retailers such as Primark, while downsizing larger stores, will also raise cash, but not in substantial amounts over the short term. Most industry analysts agree that the time for Kmart has long passed. However, its big box stores in many rural areas could appeal to developers who are looking to bring in a mixed group of retailers and restaurants. That course of action would be much cheaper to a developer than trying to find suitable locations to build from scratch. Now, the asset sales and the rights offerings have helped to generate $2.3 billion in liquidity last year, but they still needed to borrow heavily, both from existing credit lines and the $400 million stopgap loan from Lampert's ESL Investments. That short-term loan was due to be repaid at the end of February. However, they amended the loan to repay $200 million on March the 2nd and extended the balance to June 1st, 2015, or when the proceeds of the REIT transaction are received, whichever comes first. In addition, the lenders, be it Lampert and ESL, agreed to release half of the value of the pledged collateral. At January 31st, Sears had $213 million owing on its $3.275 billion revolver, with availability limited to about $800 million, which reflects the effect of their springing fixed charge coverage ratio covenant and the borrowing base limitation. Cash on hand had shrunk to just $250 million, which one Wall Street analyst deemed grossly inadequate. Total long-term debt was $3.2 billion at year-end versus $2.9 billion a year earlier. The unfunded pension obligation rose to $2.3 billion from $1.5 billion in 2013. They blame that increase on the use of updated mortality tables. Apparently, their employees are going to live longer than they originally thought. The balance sheet now reflects both a deficit working capital position and a deficit net worth figure of some $945 million. The company continues to carry about $2.4 billion of intangible assets, including the very valuable trade names of Craftsman and Kenmore, which, by the way, are held in a bankruptcy-proof affiliated company. Getting back to the latest plan to increase liquidity, they announced that they're working towards forming a real estate investment trust, or REIT, that would purchase between 200 and 300 Sears and Kmart stores with expected proceeds in excess of $2 billion. If they succeed with this deal, they could more than offset the they could more than offset the estimated annual cash burn of some $1.2 billion and would buy themselves another year or so to keep trying to turn the business around. One downside to a REIT is that those valuable stores would be removed from Sears' asset base available to unsecured creditors in the event of a bankruptcy. While the company seems to be sure that it can close the REIT deal, there have been some reports of complicating factors that have to be explored. The first is setting fair terms for the purchase and leasebacks. Sears may have to pay fair market rates to lease those stores from the REIT, and there are U.S. tax rules designed to keep small groups from having voting control of a REIT. If the rights offering succeeds with a large number of shareholders, they could avoid the issue. If not, Lampert and ESL Investments could end up controlling the REIT, and the IRS wouldn't care for that. Getting down to the issue of vendor and factor support, after digesting the results, major manufacturers continue to support Sears on normal terms with exposures to $152 million and many in mid-eight-figure amounts. The factoring community continues to share risk with clients, while hefty surcharges have been in place for quite a while. Payments remain close to terms, and chargebacks have been minimal. Our Payment Quality Index, or PQI, shows Sears at 84%, which has been basically unchanged for over a year now. Due to some long lead times, apparel manufacturers that we've spoken to continue to make business decisions here, not credit decisions. Insurance and forward puts continue to carry hefty charges, but some modest-sized vendors can't sleep at nights without them. Credit to Be has not recommended Sears and Kmart for quite some time due to the continued large losses. I think we all owe a debt of gratitude to Wall Street analysts who have come up with some very quotable comments regarding Sears. One said, "The company is heading downhill and nobody is stepping on the brakes." And my personal favorite, "Sears continues to burn the furniture to keep warm." And that pretty much says it all with Sears. Let's talk a bit about Radio Shack, that seems to have avoided a total liquidation by entering bankruptcy, but even that contains a bit of uncertainty. Radio Shack was once one of the leading consumer electronics retail chains. Its retail network included approximately 4,300 company-owned stores in the U.S., over 270 company-owned stores in Mexico, and approximately 1,000 dealer and other outlets worldwide. The company has tried unsuccessfully to reinvent itself and was attempting a program to downsize by closing a larger number of stores than its lenders would agree to. Radio Shack posted 11 straight quarterly losses after failing to transform itself into a destination for mobile phone buyers. By the way, that 11 quarterly losses is the same number as Sears. On February 5th, Radio Shack announced that it had signed an asset purchase agreement with General Wireless Incorporated, an affiliate of Standard General LP, whereby General Wireless would acquire between 1,500 and 2,400 of Radio Shack's U.S. company-owned stores. And in order to facilitate the deal on what they call an orderly sale of the company's remaining assets, the company filed for Chapter 11 in Delaware. Radio Shack's foreign subsidiaries and its franchisee-owned stores are not included in the filing, which has created an entirely separate set of challenges for those dealer store owners who were then told that they have to pay cash in advance for any new merchandise from Radio Shack. About 100 dealers have organized and want to be represented in the bankruptcy process. Getting back to General Wireless, it's agreed in principle on terms with Sprint to establish a new dedicated mobility store within a store retail presence in up to 1,750 of the acquired stores. The court has approved that part of the plan, and Sprint said that it will occupy about a third of the retail space in locations it selects throughout the country. However, Sprint has yet to disclose where it plans to set up those locations. The company also secured a commitment for approximately $285 million in debtor-in-possession, or DIP, financing from its current lender group, led by DW Partners LP. As you know, the DIP is intended to provide it with liquidity during the sale process. The DIP funding includes a roll-up of the company's pre-petition revolver, letters of credit, and its inventory facility. In addition, it'll provide up to $20 million in incremental borrowing capacity. The Unsecured Creditors Committee has objected to the DIP terms and other parts of the sale agreements. Objections over Radio Shack's DIP financing and the committee's discovery request remain outstanding after yesterday's hearing, subject to further negotiation. There is a telephonic conference scheduled for tomorrow to get back to this and other matters. The Unsecured Creditors Committee continues to challenge the entire deal and wants an investigation into claims that may arise from the October 2014 recapitalization. The committee has a larger theory that the company's trip towards bankruptcy was, and I quote, an assisted suicide facilitated by Standard General and conducted to the detriment of Radio Shack's creditors. Going out of business sales began on February 8th at over 1,700 stores. The GOB sales are being managed by a joint venture made up of Hilco Merchant Resources, Gordon Brothers Group, and Tiger Capital Group. On February 23rd, GameStop Corp. Put in a bid for 163 Radio Shack leases. They plan to add them to their spring mobile stores. Of the 1,100 leases that were being offered, only 167 received bids from interested parties. The March lease auction will offer about 2,000 locations, for which Standard General agreed to provide an opening bid as the stalking horse bidder of $200 million. It also bid another $20 million for the rights to Radio Shack's intellectual property and its name. For those of you selling Radio Shack, it remains an easy cash in advance situation, but if you're an unsecured creditor, you should get some satisfaction over the way your committee is representing you. All I can say on Radio Shack is stay tuned. Now I'll turn things over to our senior analyst, Jamie Polanka, who will bring a little good news into the presentation while he discusses the solid year that Best Buy had in 2014. But even that has a caveat about first quarter of this year. Jamie, it's all yours.
Thank you very much, Bob. Firstly, I'd like to start off by welcoming all of you to our presentation. And before I start the Best Buy presentation, I'd like to provide a brief historical background. The company started back in 1966 by Richard Schultz under the name of The Sound of Music. At that time, it was an audio store that focused on selling hi-fi equipment. The company grew and evolved, expanding its store base to the point that in 1983, out of a 7-store operation with $10 million in sales, it changed its name to Best Buy. Toward the end of 1983, Best Buy opened its first superstore. By 1987, it went public and began trading on the New York Stock Exchange. And by 1992, its sales exceeded $1 billion. In June 2009, Brian Dunn became Best Buy CEO. Brian became the president of North American Retail Operations in 2004, and in 2006, he assumed the top spot at Best Buy. During Mr. Dunn's tenure, he became involved with an internal investigation about having an inappropriate financial and personal relationship with a female employee. In addition to this, he was held responsible for not quickly responding to changing business conditions. These events eventually contributed to Mr. Dunn's resignation as CEO in 2012. At that time, Richard Schultz, the original founder, resigned his chairmanship of the board soon after Mr. Dunn's exit. Hubert Joly then became Best Buy CEO in September 2012. During his tenure, Best Buy experienced 10 consecutive quarters of declining sales, which eventually was followed by a 78% increase in earnings and a 0.6% increase in sales by the third quarter of 2014. The first 9 weeks of the holiday season of 2014 showed a significant 2.6% increase in sales that might indicate a further positive reversal in the company's fortunes. Now, I'd like to briefly touch on the company's competitive environment. Annual sales for household appliances in the country peaked for the year 2007 at $17.8 billion. This, however, has consistently trended down to the point that we're now at the $15.5 billion level. Consumer electronics revenue, according to the Consumer Electronics Association, was about $211 billion for 2014. This was about 2% greater than that of 2013. However, the rate of annual growth, though positive, has likewise pursued a declining trend, to the point that year 2015, or this year, they're projected to grow by only 1.2% over the previous year's level. At Best Buy, household appliances and consumer electrics and consumer electronics comprise the major portion of the company's sales. A variety of related merchandise, including cameras, video games, music media, car radios, and computer software, round out the company's merchandise selection. Best Buy's domestic revenue for the year 2014 was about $35.5 billion. Total revenue base was $42.4 billion. It is estimated that Best Buy sold about 14% of the total U.S. market's $226 billion worth of consumer electronics and household appliances. This comprised 35% of the $108 billion in sales at stores dedicated exclusively to electronics and appliance sales. Best Buy continues to maintain dominance in retail sales despite the availability of its products from the company's more formidable competition, specifically online retailers. A sampling of these players across other distribution channels are, in terms of big box chain retailers, they're arrayed against players like Lowe's and, of course, as many of us guessed it, Walmart. In terms of department and variety stores, we're looking at Macy's, Sears, and Kmart, as well as thousands of specialty appliance and electronics retailers that are fragmented in terms of number. Cellular network providers that distribute mobile phones such as Radio Shack and other players, and of course, internet retailers like Target, Amazon, and Crutchfield. Apple Incorporated is also among its formidable competitors, whose domestic stores are estimated to transact roughly about $13 billion worth of electronics equipment. Best Buy's internet electronic sales are growing, although the company has an improving web presence, which increased by 9.7% during the last quarter. Competition continues to be very fierce, and losses from sales generated by competing internet retailers tend to be more than the sales that Best Buy's internet business gains. Now, I'd like to review with you the recent performance of the company, as well as take a bird's eye view of both the challenges and opportunities that the company faces right now. As we know, the company reported strong sales during the holiday season. Domestic comparable store sales increased by 3.4%, which was a lot better than the 0.9% decline during the 2013 holiday season. This performance was essentially driven by strength in demand for large televisions and smartphones, which offset the softness in the demand for tablets. At about that time, I remember the stock price of the company sank, due largely to disappointing guidance for 2015. The excitement around new products like the iPhone 6 and the 4K TVs according to their CFO Sharon McCollum, was not likely to last. Aside from this, comparable store sales growth for the first half of 2015 is expected to be flat at best to a low single-digit decline at worst. All is not bad as far as the scenario is concerned, because recent interim results for the fourth quarter ending January the 31st of this year actually reflected a strong 77% surge in profitability from last year's $293 million in profit to the current fourth quarter period's $519 million. Operating profit spiked 79% from $452 million to $810 million, which was essentially driven by top-line growth, as well as a 110 basis point improvement in gross margins from 20.2% to 21.3%, and a 50 basis point decline in SG&A margins from 16.1% to 15.6%. Consolidated sales increased 1.3% from $14 billion to $14.2 billion, as domestic revenue increased 3.2% from $12.3 billion to $12.7 billion. This was reflective of the impact of domestic comparable sales, which grew by 2%, as well as a 9.4% increase in comparable online sales. This easily mitigated what was a 12.4% steep decline in international sales from $1.7 billion to $1.5 billion, due primarily to currency headwinds and underperforming Canadian stores. The gross margin strength, which reflected a 120 basis point improvement, was driven largely by more effective promotional strategies, continued transition in the company's renewed Blue program, which included improvements in supply chain efficiencies, as well as higher margin recovery on returned, replaced, and damaged products. Aside from this, gross margin also benefited from the positive effect of changes in their mobile warranty plans, which resulted in lower costs from lower claim frequency. Lower operating expense margins reflected the benefit of sales leveraging driven by the realization of their renewed Blue cost reduction initiatives and tighter expense management. As far as the turnaround that was initiated by the company's CEO, Best Buy has made plenty of progress toward turning around its business in terms of slashing costs, lowering prices to become more competitive, driving rapid online sales growth by shipping orders directly out of its stores, and reducing the scale of both its Canadian, European, and Chinese businesses. The focus now is clearly on the U.S. market, and with Best Buy being the only major nationwide consumer electronics retailer left standing, this gives Best Buy a meaningful advantage. Today, Best Buy is leaner than it's ever been. During the trailing 12-month period, as a matter of perspective, Best Buy just spent 19.2% of revenue on operating expenses, which was about 3 percentage points lower than their level in 2011. The company, up until recently, when I say up until recently, up until their fourth quarter results, experienced some challenges for a while. as Best Buy struggled to be more price competitive. However, profitability has since then stabilized and actually improved significantly. Going forward, however, Best Buy's operating margins would experience more pressure than in the past. However, because of the changes as well as operational improvements that Best Buy has initiated, they expect to remain continuously profitable. The company has also been picking up market share during the 9-week holiday period. Industry sources disclosed that while the consumer electronics industry declined by 3.7% relative to 2013, Best Buy actually continued to increase and improve price competitiveness, which, while hurting profits in the short term, has enabled the company to increase its market share. Also helping in this situation was the fact that the company's e-commerce business continued to grow. During the holiday seasons, online sales actually grew by 13%. While this is slower than the 23.5% growth rate during the previous year's period, it continued to reflect the full rollout of the company's Ship from Store program. Now, as we've previously heard, Best Buy anticipates 2015 to be a challenging year. For one thing, the strong holiday season is not expected to carry over to the first half of 2015. Comparable store sales could decline, according to management, and margins will be squeezed by both lower sales and continued investments that Best Buy must make toward advancing its business strategies. With operating margins already in the low single digits, a 30 to 50 basis point decline that management is predicting for the first half could somehow have a significant impact. Notwithstanding, Best Buy continues, or in spite of the fact that Best Buy continues to experience weak demand for consumer electronics, the silver lining is that Best Buy, amid the tougher environment, continues to perform much better than its smaller rivals like H.H. Gregg and Conn's. H.H. Gregg will continue to suffer from steeper declines in comparable store sales, while Conn's continues to experience challenges to profitability, resulting primarily from looser credit policies. Additionally, as Bob previously mentioned, Best Buy stands to benefit from Radio Shack's bankruptcy filing. Radio Shack is closing part of its stores while selling up to 2,400 of its stores to Sprint. Up to 1,750 of these stores will be converted into stores within stores configuration within Sprint's business. Another major strength that's going for Best Buy is it has an extremely strong balance sheet. For one thing, Best Buy's cash balances, or near cash assets, actually hit $3.5 billion as of its year-end closing, and this compared to funded debt of about $1.62 billion. Free cash flow on a 12-month rolling basis was actually roughly about $1 billion. Additionally, its recent strength in profitability caused its net worth base to expand by an impressive 25%, from February the 1st, 2014's $3.9 billion to $5 billion. As many of us may have noticed, even the stock of Best Buy over the last 6 months has been on a tear. In some cases, you've had reports indicating that their stock has increased by about 50% in the course of 1 year. As long as the consumer industry remains weak, Best Buy's margins are likely going to be depressed. But even in this difficult environment, the company continues to generate considerable profits to the point that any uptick in demand in the consumer electronics business could only leverage the degree of growth and strength that Best Buy can be expected to enjoy. Now, what's ahead for Best Buy? When I say what's ahead, at least strategically in certain areas, critical areas that the company is looking to focus on. Now, in spite of its strong financial performance in terms of increasing sales, improved gross margins, reduced costs, and higher online revenues, the company takes a rather cautionary stance in terms of providing guidance, as their management sees aggressive pricing by competitors and a declining demand, with tablet sales declining and mobile sales becoming increasingly dependent on new product launches. Best Buy needs to explore other sources of growth. Among these critical sources of growth that they look to focus on going into 2015 and into 2016, one of them is the upcoming boom in ultra-high definition TV market. Ultra HD, also colloquially known as 4K, is the latest technology in televisions. These essentially have 4 times the resolution of a standard 1080p television. Industry experts expect this next generation technology will inject some profits back into stagnant industry. The global market for big screen televisions is rebounding as consumers look to replace their flat screen devices that basically hit the market a decade ago. According to the Consumer Electronics Association, the number of shipments of Ultra HD TVs are forecasted in the US to grow at a compounded annual growth rate of 107% annually between 2014 and 2017, which should clock in roughly about $4 million in terms of unit sales by 2017. What is the balance of this technological shift in terms of Best Buy's business model is that for a product that has a high level of technology such as this, consumers tend to look for closer hand-holding, closer attention, as well as more focused service. Now, in a CEA study on consumer purchase decisions, the top 3 obstacles toward making a purchase were found to be that consumers wanted to see the product in a store, as well as wanting a demo and talking to a salesperson that is well trained in that product. Essentially, the need for human contact and insights relative to the product is a lot more. With experience centers for different brands and its in-store expertise, Best Buy is better positioned for this. This should enable Best Buy to capture a healthy share of the 4K TV market. Currently, Best Buy is the leader in consumer electronics with about roughly 30% of this market. With all of the above factors in Best Buy's favor, this product category could actually be the much-needed boost for Best Buy's top line. A second area that they're focusing on has to do with capitalizing on categories with higher barriers to entry. Now, in the past, the capital-intensive nature of Best Buy's business model has been its Achilles heel, in the sense that you'd have consumers looking at Best Buy showrooms, touching the product, and then buying them more cheaply online. That's because the belief was online retailers such as Amazon were able to take market share away because of the relatively lower cost overhead that they had relative to maintaining a big box store like Best Buy. However, it also serves as a barrier to entry when it comes to products with high quality requirements. And this makes it difficult for new players to enter the market. Recognizing the advantage that this possesses, Best Buy decided to expand aggressively into categories which are growing and are capital intensive, such as large appliances and connected home through its store within a store concept. These are basically spaces within a Best Buy store which are occupied by popular brands. They have large product displays, dedicated checkout counters, and trained employees from the respective companies to guide customers. For one thing, aside from the immediate benefit of rent being earned by Best Buy from these partners, it also provides the possibility of driving increased traffic through the entire store. Studies made by the University of Pennsylvania and Carnegie Mellon says the concept can actually boost sales of high-value products that require or need a degree of service and can't easily be found anywhere else in the store. Best Buy has actually experienced the success of this particular paradigm in that, if you recall, back in 2006, the company has been able to generate impressive comparable sales growth from Pacific Kitchen and Home, an upscale appliance chain, which they purchased. It is now another store within a store, and moreover, it positions Best Buy to capitalize on an improved housing market, as Best Buy is able to push into appliances and target new home buyers and consumers who want to remodel. As a matter of fact, it is also another way by which Best Buy can actually mitigate gross margin erosion. And this can be done by allowing it to obtain partnerships with brand names such as Samsung, Sony, and Lucky Gold Star. A third area that Best Buy is focusing on are targeted marketing investments. In the past, what Best Buy used to do was invest substantial amounts of its marketing and advertising spend on major sporting events as well as star-studded ads. Going forward, Best Buy will be shifting its marketing spend more towards targeting digital marketing. Through its vast database of information on customer preferences and behavior, Best Buy is investing in the development of a customer base called Athena. Now, this will enable them to basically tailor marketing messages instead of mass email campaigns to customers based on their previous purchases or browsing history. gradually Best Buy hopes to eventually compete in terms of capitalizing its core strengths as opposed to merely just responding on the strengths of its competitors in such a way that they become more proactive as a retailer rather than merely reacting to initiatives by their customers. Now, understandably, while all these plans make perfect sense in theory, it still remains to be seen how successfully Best Buy can convert them or translate them into improvements in their top line as well as increasing their bottom line profits. I guess that wraps up my presentation. And again, I'd like to thank all of you for attending our presentation, and we look forward to hearing from you in the near future. Thank you very much, and I hope you all do better with the snow.
Thanks, Jamie. So just so everyone can see on the screen right now, if you guys do have any questions, you can feel free to reach out to either Bob or Jamie on any of these accounts or any accounts that you may have a question on. As you know, through any customers or members of Credit to Be always have access to these analysts at any time they would like them. If there are, so you can put your questions in here. And with that, I think we're going to shut the presentation down. Thank you, everyone, for coming out today and listening to Bob and Jamie speak. I hope you were able to get a lot of value out of what they said. And also, if you could just fill out the survey, it takes about 15 or 20 seconds right when you exit the webinar. So thank you guys again. I hope you guys have a great rest of the day and stay safe. And thank you as well, Jamie.
Thank you, sir.